Hello and welcome to BQ Prime. A very good morning to all the viewers. You're watching Stocks in Focus, and I'm Hiral Dadia. Two counters that we are going to discuss today. The first one being a TTK Prestige on the back of earnings. Clearly, the revenues are down around 13%. Margins have gone down as well, and the reported PAT has declined 30%. Let's understand as to what's worked and what's not worked, and what's the trajectory looking like going ahead. Joining us on the show is Mr. TT Jagannathan, Chairman at TTK Prestige. Good morning and welcome to the show, Mr. Jagannathan.
Good morning.
Mr. Jagannathan, if you could help us understand what has worked and what has not worked during this quarter, and what is your analysis of how the earnings have been?
There's nothing wrong with the earnings as far as I'm concerned, because this quarter by quarter comparison in India doesn't work. Because last year, for instance, we were coming off COVID and the share of wallet was all towards the home and the kitchen. We benefited. We grew hugely last year. This year, the share of wallet got away to travel, restaurants, luggage, clothes, and so on. So we've lost share of wallet. These are minor hiccups. It'll improve.
Right. So basically, it would be right to say that the base was higher last time because of COVID, and that's the reason optically we are seeing these kind of numbers.
That is one. And the second, that Diwali has shifted from October to November. So the sale is moved from second quarter to third quarter. Third quarter will be much better than last year.
Understood. Now, overall, how is the competitive intensity panning out? Is it increasing? And if that's the case, what is the impact you're seeing on traditional players?
Competitive intensity has always been there. It's not new. It goes up, it comes down, it goes up, it comes down. But we have a very strong, loyal clientele and they don't leave us.
Absolutely. And any discounting that Prestige has taken in the quarter?
No.
Right. So do you think that could be a strategy? Because you are seeing a lot of discounts being given by competitors, newer brands who are coming in the market. Do you think that could come in as a spoil sport?
You watch the third quarter and then tell me.
Absolutely. I'm sure everyone's watching out for the third quarter, because for the consumption space, a lot of it has shifted to the third quarter because the festivities in terms of Diwali, as you mentioned, will be in the third quarter. Overall, if you see in terms of the product mix, the sales promotion, how is the margin profile expected to pan out going ahead?
I didn't understand the question.
No, my question is in terms of the margins, even they have dipped, right? So is it that there's going to be a change in the product mix? The promotions that the company has been doing will be lower, and that is something which will help the company get back to the margins that we've seen in the past?
No. We have not reduced our margins at all. The margin per product stays constant. What happens is if the sale is lower, your overheads are still higher, so your gross margin seems to come down. But the margin per product is not changed and we have not discounted.
Got it. And overall, what is the kind of inventory that the company is sitting on right now?
Probably 10% more than we should, but that will go away in the third quarter.
Okay.
We had built up for a higher scale.
What's the plan with... Sure. And what's the plan with the repositioning of the Judge brand? Is it progressing as per plan?
Yes.
And yes, go on.
You asked me, are we progressing to plan? I said yes.
Okay. And overall, by when do you see the benefits flowing in of it?
Of the Judge brand? To build a brand will
Yes.
take at least 5 years, but we will start seeing benefits from the second year.
Right. Apart from that, Mr. Jagannathan, you're also launching a premium brand to tap the consumers at the top end of the clientele. So, what portion of the revenues will come in from the premium segment? Because in the consumer space, premiumization now is becoming the key.
We have not put a percentage to it. As a strategy, we are launching a premium brand. We'll wait to see what happens.
Okay. And between cookers, cookware, and appliances, where do you see the traction coming in?
Well, it has to be in appliances because the cookware and cooker segment is largely fully mature. It's the appliance segment where there's a huge gap in terms of need.
Okay. So overall, from a growth perspective, if you have to look at FY 24, 25, and 26, let's look at 3 years. What is the outlook you're looking at, and what is the key milestone that TTK Prestige wants to achieve?
I am not at liberty to reveal that. However, we have revealed that in FY 27, our aim is to reach 5,000 crores.
Okay.
I think we are on track
overall, okay. So will this mainly be led by new product launches as well?
New product launches, new acquisitions, larger exports, a whole basket of things.
Okay. And you're saying acquisitions in what category of products are you looking at? Because if I'm not mistaken, post the capex that TTK has incurred, you already have a free cash flow of around 860 odd crores.
Yeah. True.
So where, in what segment are you looking at acquisitions? And will there be acquisitions in the current calendar year, or are you looking at, say, 25, 26?
We've been looking for the last 2 years. We have not found a fit, but we are constantly looking. So I can't give you an answer to that.
Okay. Got it. And overall, from a region and geographical expansion perspective, where are you seeing the traction come from? And where do you think you will be putting in your energies in terms of achieving the growth?
Across the country geographically.
Got it. All right, Mr. Jagannathan. Thank you so much for speaking to us at BQ Prime. And good luck for the coming quarters. And we will be waiting to see how the third quarter numbers pan out with all the festive impact coming in there. But the quarter is expected to be better than the previous quarter. Thank you. Stay safe and speak to you soon again.
Thank you.
So that's the management. Always a pleasure to speak to you. That's the management of TTK Prestige. Clearly, if you see, yes, there has been weakness in the second quarter. But overall, if you see from a quarterly perspective, as the management has mentioned, the quarter has been weak, but that's mainly on the back of the festivities, specifically Dussehra as well as Diwali, which has actually moved to the third quarter. So the third quarter, in fact, is expected to be better than the third quarter of FY 23. That's what the management has indicated so far. Apart from that, on the margin front, they've not taken any cuts, no discounts that have been given from a product perspective, though competitive intensity has been increasing. Competitors have gone ahead and given a lot of price discounts as well. Now, whether that has led to market share erosion or not for a TTK Prestige or for any of the traditional players is something we need to wait and see. So that was one aspect of it. The other aspect being it's going to be newer products that will be driving growth for the company. Overall, what the management has indicated so far as well is that they are looking at acquisitions. They're sitting on a free cash flow of almost around 860 crores. And this is post incurring the capex as well. In fact, they have been repositioning the brand Judge, and the management has indicated that the repositioning has been progressing as per plan. If you talk about these investments, what analysts are of the opinion is that FY 25 and 26 is when you will see all of these investments play out as well. So it's going to be interesting to see how this looks like. They've introduced almost 49 new SKUs during the quarter across four categories, and new launches are being received well overall. In fact, the Prestige exclusive chain strength now stands at 678, in 370 towns, which contributes significantly to the total sales as well. So overall, an interesting quarter. Yes, the management is saying it's optically weak, but clearly the base was absolutely high on the back of the COVID years, and that has gone down tremendously. Overall, let's also quickly look at few of the other names which have been in focus today. We'll just do a quick market check and see what the markets are looking like as we speak. If you see in terms of Nifty 50 as well, it was interesting to see how Nifty did go down below the 19,000 mark, but recovered sharply from there. 19,090 is where Nifty is trading, and it's mainly Reliance Industries, which is one of the top contributors to the gains. If it wasn't for RIL, we wouldn't have seen this. BPCL, Cipla, and SBI Life. If we talk about the top 5 gainers in terms of Nifty 50 on the back of earnings, all of these are seeing smart moves. Autopac continues to remain under pressure in today's session. So the top 3 losers are Maruti, M&M, as well as Tata Motors, that are down and about in trade. NTPC as well reported numbers on the back of which the stock is down almost 1.5% in trade. So that's with regards to the top, the broader market, the benchmark indices. But let's quickly look at the broader markets as well. M&M Financial was the key highlight as the markets opened up, and this was mainly on the back of earnings. 10 to 11% is the kind of downtick that we have seen in terms of M&M Financial as well. But apart from that, AU Small Finance Bank, in fact, AU Bank, 7.5% downtick. They've announced the merger, and on the back of earnings, that stock is trading under pressure. SBI Cards as well has reported numbers. That stock is down over 5% in trade. So all of these are mainly on the back of an earnings impact. Let's see which are the ones which are gaining in trade. JP Associates has been an interesting one. In fact, since the time there have been murmurs with regards to acquisition of smaller cement players, JP Associates also has been in the league. That stock has been doing pretty well. Today around 12% is the kind of up move that we've seen. But if you see the last 1 month performance, 22 to 25% is the kind of gains that we've seen with regards to where JP Associates is concerned in trade. Moving on, in terms of other counters, you have a Welspun India. That stock is up around 7%. In fact, on the day of the earnings, when the earnings were reported, the stock slumped under pressure. But after that, the recovery has been pretty strong, and Welspun India has seen gains in the last 2 to 3 trading sessions. Chennai Petro is another one which is seeing gains of over 6% in trade. So clearly, a lot of stock-specific action is what we're seeing in the markets. And if you see in terms of the Sensex as well, let's just quickly look at the top contributors which are helping the Sensex Reliance. 150 points contribution to Sensex gains. HDFC Bank, 55 points contribution. ICICI Bank, a 25 to 30 points contribution coming in there. TCS, Bharti Airtel, Asian Paints, these are few of the top contributors which are contributing to the up move as well. So that's with regards to where markets are concerned. But let's quickly shift focus to another stock which is in the news today, and this is on the back of earnings once again. We have the other management that will be joining us now is Mr. Rajan Sethuraman, CEO of the Latent View Analytics, to discuss more in terms of how the earnings have been and what has worked and what has not worked during the quarter. Good morning and welcome to the show, Rajan.
Yeah, hi, good morning, and thank you for having us on this.
Always a pleasure to speak to you. Rajan, if you could help us understand, has the quarter firstly met your internal expectations?
Our internal expectations were definitely higher than how things have panned out in the first half of the year. But we are also cognizant of the fact that the entire economy, macroeconomy, has been sluggish. And in some sense, if I compare our results with what is happening in the rest of the IT sector, I think we are still on the right trajectory. We have always indicated that we will do better than, at least 5% better than how the rest of the industry is faring. And we have done decently well right on that front. Of course, we were hoping that the second half of the year will hold a lot more promise emerging out of Q2. We still see some sluggishness from a demand perspective. Incremental growth is happening, right? We are seeing additions to existing book of work with our current stakeholders. New initiatives are still taking longer to sign, and even when they sign, they are starting off on a smaller scale in comparison to what we are used to in the past. So still fingers crossed on how the rest of the year pans out.
Right. So if you could help us understand which are the segments which are looking sticky, and which are the segments where you could see growth emerge?
Right. For us, technology and digital native sectors have always been a very important sector and a contributor of growth, as well as knowledge capital, right, to add to our capabilities. We continue to witness that even in the last quarter. We added quite a bit of work in the existing accounts. In fact, one of our accounts, it actually crossed the 15 million per annum annual revenue run rate. Which is a big milestone for us. So technology continues to remain a fairly strong sector for us. We are seeing good momentum in industrial services as well. This is automotive, oil and gas, logistics, and so on. We started off some interesting engagements in that space. And BFSI and retail, that is where there is still quite a bit of sluggishness. I think most IT sector companies have also talked about challenges as far as banking financial services is concerned. Retail, again, because of inflation and other concerns, it is slow to take off. So I think we will continue to double down on those sectors because we are also underrepresented in that space. And much of the work that we do in the technology space, at least on the customer marketing analytics front, is quite transferable. So this is something that we are also betting on going forward.
Right. So overall, how is the market looking like with regards to project size? Because clients, customers, we've been hearing have been taking initiatives for smaller projects. Do you see that shift happening towards larger projects? Is the confidence coming back, or you still see where there is that cautiousness that prevails?
Yeah, in terms of initiatives that have been kicked off in the first half of the year, it has definitely come down, the size of initiatives, as I pointed out. We, in fact, had an internal threshold of $500,000 for even deal incentives for our front-end sales and business development people. However, what we have witnessed in the first half of the year is more along the lines of $250,000, right, in terms of new initiatives. However, the pipeline that we have at this point in time, there are quite a few big opportunities, $1 million and plus. Only thing is that they are moving much slower at this point in time. And a lot more ducks need to be aligned, right, before the sign-off happens on those initiatives. So that is where the sluggishness is quite real at this point in time. We are expecting that once clients get a better handle on how they are finishing off this year and what their intentions are for the next year, it'll become clearer, to us as well in terms of how the initiatives are going to pan out, how many initiatives and what will be the size of the initiatives. At this point in time, there is cautious optimism in terms of how next year could turn out in terms of the size of the initiatives based on the pipeline that we have built at this point in time. We yet to need to convert and start seeing the traction. Europe in particular, I believe that it'll take a little bit more time. As I pointed out, I'm sure that we'll get a bunch of initiatives underway with new accounts, but I'm expecting that the pickup in terms of size of opportunities and scope of the work that we do will start picking up pace only in about 3 quarters or so, and not before that.
Right. So are we saying that probably the first quarter of FY25 is going to be absolutely crucial to understand how the demand scenario pans out, and the current quarter and the fourth quarter of FY24 are going to be probably will continue to remain sluggish?
Yeah, I believe that our own performance in quarter 3, which is the quarter that is currently underway, will be better than what we did in quarter 2. However, we will get a better handle on how the full year, this current fiscal, as well as how next year is going to look like, will become clearer only by the December-January timeframe. A lot of our renewals of the existing book of work happens in December-January. So once the renewals are completed and we connect again at the end of quarter 3, we'll be in we'll have a more clearer position, right, in terms of how the rest of the year is going to pan out. Of course, the economic scenario has to improve as well, right, in terms of clients starting to spend money on new initiatives and larger initiatives. There's a lot of talk, though. I mean, as I said earlier, if I compare the number of opportunities that we have in the pipeline and the value of the opportunities that we currently have in the pipeline, it is more than double of what we had at the same time last year. So the conversations are happening and underway. closures are what are taking more time. And I believe that the next quarter or so is when the picture will get clearer. So hopefully when we connect in January, I should be able to share more information.
Right. The other aspect I wanted to check with you is I know, you have mentioned overall that, there are a lot of things that will probably help understand the picture clearer later. But I think in the previous con call, the company had mentioned that once the H2 demand comes back, the company hopes to end the year with a trajectory of between 23 to 25% in terms of margins. Where do you stand currently? What does it look like now?
Yeah, the margin trajectory has started improving. So if you see how we did in Q2 versus Q1, you already see the improvement. But obviously, it is not as much as we were expecting. And that is largely because of the fact that we haven't really cut back on any investments in relation to the growth that we had anticipated. We were looking at a trajectory of 25-30% revenue growth. And a lot of the investments that we have made at the front end, our sales and business development teams, advisors that we have brought on board, the capability building is all in line with that 25-30% growth. So, however, as you see, the current growth trajectory is a little shallower than that. So the margin profile returning to the 25% kind of a range will be predicated on how quickly the demand trajectory picks up. We are not worried about it at this time because we believe that it is important to make the investments, right, when there is a bit of that sluggishness and downturn and build that capacity and capability. A lot of the work is really going into the new value propositions and solutions that we are building, especially in relation to all the buzz and excitement about generative AI, for example. This will all start panning out and yielding results, right, when the demand trajectory picks back up. We don't want to be in a situation where we have to play catch up at the point in time. So we are a little ahead of the curve and we are okay with the margin profile. My expectation is that we'll start getting closer to the 22-23% as we exit this year if things continue on the same course. Q3 will again give better signals. So when we meet in January after the Q3 results, we'll be in a better position to provide some guidance on how the entire year will pan out for us.
Right. And very lastly, any layoffs taking the way the industry has been panning out, and how are you maintaining your utilization levels?
No layoffs from our end at all. In fact, we have been adding people, but we have been calibrated. In fact, last year, we did a significant shift to campus hiring and made a substantial number of offers. There are almost 300 plus acceptances that we had. The good news is that we have onboarded 1/3 of them, and we will probably get to the 40-50% mark before the end of the calendar year, and the rest of the people will get onboarded in early January, right, depending on the demand trajectory. We also continue to go to campuses at this time. In fact, the current campus recruitment season that is underway for the batch that is passing out in June, July, we are making about 200-250 offers based on the projections that we have, right, for the next year, attrition, right, all of that taking into account. So at this point in time, we are continuing to rely on campus hiring as the main mode for growth and expansion from a people standpoint. Of course, we will do some hiring as well, right, of lateral skills, depending on urgency and some esoteric skills that are called for.
Absolutely. So I think lots to watch out for in this industry as well. Thank you, Rajan, so much for joining us on the show and sharing the views. So that's the management of LatentView Analytics, clearly indicating that, yes, there is some bit of cautiousness that does prevail, but probably by the next quarter, we'll know how the future is expected to look like. That's all that we have on this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned to PQ Prime.